Hi, I'm Soleil. I'm an angel investor and venture capital investor based in Sydney. I'm going to share at a high level about the different types of venture capital investment and also the different types of venture capital investors. So, this presentation was originally part of a presentation that I gave at the Western Sydney Startup Hub Innovation Festival. I received a lot of great feedback, and so I've decided to break up the presentation into smaller videos and share this more widely because this information needs to be out there. So let's begin. So, here are the different types of venture capital investment that we're going to go through in this video. I'm going to explain at a high level what they mean, and also some key things to watch out for when you, as a founder, are exploring each of these options. So let's start with bootstrapping. So essentially, the term means that you are using your personal savings. Maybe this is between you and your co founder, or perhaps you're generating some profit or revenue from your operations and you're reinvesting that back into the business. So, what this means is that you retain ownership because you aren't selling shares in exchange for investment. And this is referred to as non dilutive investment. So, this can be high risk, and this is for obvious reasons because you're using your own savings to invest in the business. And we just need to recognize that perhaps you have other commitments, priorities, or people who rely on you. So, hence the risk. It can also limit initial growth. And so, for example, if you're using that revenue or profit from the business back into the business, this could take some time versus, say, if you were injecting quite a large investment capital amount straight into the business. So these are just a couple of points to be mindful of. Next, let's move on to grants. So, grants are typically you don't need to repay them, and they're often provided by government, foundations, or other organizations. Similar to bootstrapping, this is non dilutive, and this is because there is no exchange of equity ownership. Often there may be criteria in order to apply for these grants. So, for example, you may need to look at a particular focus area or a sector, or perhaps there's a targeted outcome that the grant organizations are looking for to be achieved. So, because of this criteria focus, sometimes it can be difficult to be eligible for these grants. Also, there's a lot of effort required in applying for these grants, and or not to mention the competition, because when you think about it, it's a pretty great deal of non dilutive capital. So, here we have incubators and accelerators, and as the name suggests, these organizations incubate or accelerate a startup. So they provide resources, mentoring, and sometimes funding as well. I just want to share two accelerators that I am a part of. One is Catalyzer, which is for migrant and refugee founders, and the other one is Press Play, which is for corporate women who are starting to make their foray into the world of entrepreneurship. So it does depend on the structure of the program as to whether it would be a non dilutive or whether you will be providing an equity stake. Or there could be a fund that is related to the incubator or accelerator that could provide an investment of capital as well. These incubators and accelerators, they're typically fixed term programs. So, usually in Australia, I see them as 3-month long programs. You get access to networks, to resources, and it is a fantastic opportunity to iterate your product and to get that feedback from lots of mentors and advisors, hence the name Accelerator. Next, we have equity crowdfunding, and this is where you receive capital from a group of individuals via online platforms. In Australia, an example of this is Birchal. And there is an exchange of capital for equity ownership. So you will be providing an equity stake. You may be able to access a wider investor pool, which can be really great, especially it's good on the marketing side. Where you're able to, when you're marketing the investment deal, you can also show this to prospective investors as well. And it's a great way that these early adopters, consumers, can be your cheerleaders too. I've seen equity crowdfunding done really well for consumer facing businesses and also consumer product businesses, but it's not exclusively just for them. So if you don't sit in those categories, of course, you can go for equity crowdfunding. Next, we have family and friends and angel investors. Perhaps you're fortunate enough that you have personal connections who have capital and they can invest. Or there are angel investors, and these are professional investors that invest in early stage startups. So I would count myself as an angel. You may also hear the term, or acronym, I should say, HNWI, and this stands for high net worth individuals. And so sometimes that's what certain angels are also called. There is an exchange of capital for ownership, so you will be providing an equity stake. If you are doing business with family and friends, then I highly recommend that you do this as a business transaction and you be really careful and cautious about the terms that you agree. If you are building a venture capital backed business, then you will be raising funds every 12 to 24 months. And so you really want to ensure that the early stage rounds that you do not jeopardize your future rounds of capital. I'll be sharing a bit more on how to think about dilution and structuring your rounds in another few videos. But this group of early investors, so your family and friends and your angel investors, they can be your biggest advocates at the early stage. Next, venture capital. So these are firms that are investing funds into high growth startups. So, very similar to the family, friends, and angel investors, but generally they're putting in much larger checks. Here you may start to hear the terms lead investor. And what this means is that, for example, if you're raising a $2 million round of capital, a lead investor will take at least 50%. So in this example, they would take at least $1 million of that $2 million round. They're also negotiating the terms of the deal as well. So, a VC firm, they should be able to provide you great access to networks and resources. And because they are likely to have a portfolio of other startups that they've invested in, you can learn from those portfolio companies as well. Lastly, we have debt. This is a loan, but sometimes there are components of venture debt where it's a loan, but there's an equity funding component attached to it, and this depends how it is structured. So they can get a little bit complicated. And so loans, similar to your mortgage or your personal loans, you are repaying the debt with interest. Typically, debt providers to startups, they're looking for metrics to show your ability to repay. And for this reason, it can be difficult for early stage startups to access this because they just may not have the traction or metrics to be able to show this yet. So I'd say debt products are usually for those who are later stage with more metrics and traction and can show that ability to repay the loan. So, that was a brief overview of the different types of venture capital investment we have. So, hopefully, I've provided some high level definitions where equity exchanges can occur, and also just a couple of tips and points to note of what to look out for when you're exploring each of these in a little bit more detail. But I do want to focus on this cohort of investors. So, as a reminder, venture capital investors, they invest in early stage, high growth, potential private companies, also known as startups. So, they're providing capital in exchange for equity ownership. So, we're going to focus on three types of investors within this cohort: the angel, the family office, and the venture capitalist. And we're going to look at the differences between them so that you have a better idea of how to approach them, and also just a little bit more insight into maybe how decisions are made because of how they're structured. So, the angel investor, they are investing for themselves and they're investing their own personal funds. So, because of this, they are the ultimate decision maker. They decide what they will invest in, how much they will invest, and of course, this is subject to them having access to the deal. So, the mechanism or how they decide to invest, that could be, maybe it could be through crowdfunding, maybe through a syndicate fund, maybe they're directly investing and having a dialogue with the startup. Or maybe they are invested in a venture capital fund, which I'll come to a little bit shortly. Ultimately, as an angel investor, it's their own cash and their own decisions, and they have their own timelines as well. So they may be traveling and unable to invest, or they could have investment priorities elsewhere, or that they don't have the capital, or perhaps they only invest in very particular sectors or areas. So that's something really important to understand. Next, we have the family office. And this has been increasingly growing in the Australian market, which is a good thing. More investors is a good thing for founders, I think. The investors here, they could be family members or an employee who isn't part of the family. So I have worked and consulted for family offices where you're an employee or you're a contractor and you're not a member of the family, but you are helping invest on their behalf. So the source of capital, very similar to the angel investor, it's coming from the family. And depending on how the family office is structured, the decision making could occur by some senior family members, or maybe it's a little bit more structured and they have an investment committee, which could be made up of a mix of family members and also employees, or even external advisors or experts. Next, we have the venture capitalist, and they work for a VC firm. You may hear the term managing partner or general partner or GP. These are the people, they own the firm and they run the firm and they invest capital on behalf of limited partners. So this is where the source of capital is coming from. The limited partners are investing in the fund. And so before, when I was explaining about the angel investor, they could invest in a VC fund where they become a limited partner in that fund, so an LP, and then the GP, the general partner, is investing on their behalf. So you may hear these acronyms of LP and GP, and this is how the interaction works. So GPs are making investments on behalf of the LPs. The decision makers are the investment committee at a VC fund, and this could be comprised of the general partners and maybe some other employees of the VC fund as well. So that's a little summary of the different types of VC investors. I felt it was just a little bit important to spend a little bit of time to understand who they are, where the sources of capital are coming from, who the decision makers are, so that you know how to approach them. I hope that's given you a little bit more insight into venture capital, the different types of investment, and the investors. Let me know in the comments if there is any other terms or aspects you'd love a deeper dive on.